Hello and welcome back to another day of charting. Today we had the stock market moving on the Fed's news. So it looks like the bulls heard our cries or our pleas for a move higher because they heard our SOS and we are starting to move higher. So today we want to find out exactly what the Fed said and why it moved the market. So let's get rid of all these lines. And first of all, let's look at the technical price action to try to understand whether or not we are seeing evidence that we are bullish or evidence that we are bearish just before we look at those headlines from the Fed. So here's the first thing I notice. We got a higher low and a higher high. We have a doji and we closed higher than we opened. So far, that would give us, we'll go here for BU for bulls and we'll go over here BE for bears. So what I'm noticing is at least one check here for the bulls. Why? Higher high, higher low. We got a second check here because we got bigger green volume than we did yesterday. All right, so that's two for the bulls now. Now we look and see, did we actually close above yesterday's high? Check. Yes, we did. Did we close above the relative low? Answer is no. That's one for the bears. Now we look back to, did we actually get inside the gap zone? Absolutely. We got back above 382. So what is that? One more point for the bulls. Now, the final thing is, what is the dominant trend? Dominant trend's still pretty bearish, so I would say that we got 2 points for the bears today and 4 for the bulls. So bulls are looking better, but again, let's remind ourselves of where we came from. So looking here at the weekly chart, yep, still got a massive hole in the chart, still down by 2.7%, and this is still pretty red. So the fact that we're back to a doji means indecision, which is why it's so important that we try to understand who is actually in control of the tape, because it tells us what should be happening. All right, so now that we have that in mind here, again, what did we see? Well, we saw a broad-based risk-on rally for what? Chips leading tech, tech leading SPY, notably the trillion-dollar companies. Microsoft up 3, Google up 3, Apple up 2, Nvidia up 4, Amazon up 5. And what I noticed is that these trillion-dollar companies are up between 2 and 5%. They actually did better. Oh, ARK actually closed up quite a bit more now. So ARK is up by 6.5% today, but I think that the trillion-dollar companies or the leaders of yesterday really did their job to hold up. I also noticed a few more things like BTC and ETH coming down to roughly, right, if we have a look here, BTC, USD, we look at our low of the day today. Let's get rid of all these lines to make sure it's easy for us to follow. Our low is 2,079. So, 20,079. So within $79 of actually breaking to a fresh low. What I also noticed is that we actually formed a higher low on the 1 hour going into the Fed. So there's our low at 9 a.m. And we put in a higher low going into the Fed, which means that we were actually able to hold onto that low, hold onto that $20,000 area. Also held for Ethereum. So Ethereum hit a low of 1013 overnight, and then we had 1042 at the FOMC. When we look over here to ES and NQ, and I'm looking at these because of when they close and open the hourly candle. So here we note that, whoa, fat doji. Then we have price discovery higher with a higher low and a higher low and higher high. And then we have another doji. So that is a huge range. We broke the range by going bullish, and now we're right back to where we are. So now, and let's look at NQ just to make sure we look at all the risk assets that really matter. All right, so NQ pretty much looks like ES, where again, fat doji, fat range, higher high, higher low, puked most of it up. Now we have another inside bar. Perfect. So we understand what happened to the heat map. Let's have a quick look at the fear and greed indicator, right back to 20. So from 17 yesterday up to 20 today. So now, what did the Fed say and why did we go higher? So why did we actually get that big knee-jerk reaction? So we did get a 75 basis point meeting. I think I forgot to say that. So we got 75 at this meeting. It was largely priced in. So we look here and see that Powell's comment of don't expect 75 basis points to moves to be common. So what is he saying? We are moving faster on the front end to make sure that we have more control and more flexibility, but do not expect these to be common. Market loved that. So this is actually quite positive. But remember that listen to words and trust actions. Only like a month ago, Jerome said that 75 is never going to happen. It's off the table. So we're getting some relief here. And we have to ask ourselves whether or not the market is still discounting or taking what Jerome has to say into account. Second thing here is that this is the other really important one for me. Right? I think we can get a softish landing. Much bigger chance now. It will depend on factors outside of our control. We just don't know if we can. So I like that he is starting to say that we have less confidence than we did even like a month ago. What I did not really hear though is that why were you wrong? Why did you get it so wrong for so long? And could you just admit it? And the reason I say that is because everyone else has done it. We even had an emergency ECB meeting because they realized that we have to address these things now. The Bank of Canada did it. Joe Biden did it. Right? Who else did it? It was Janet Yellen also did it. I did not really hear that from Jerome. What I heard him blame were external factors like commodity prices, like what's happening in Europe, like what's happening in China. I would have loved him just to just say, here's why we got it wrong, and here's how we're adapting so that in the future, we're less likely to be wrong. You're saying, I don't know. What does the market love? Market loves certainty. I think we can maybe get a soft-ish landing. I just don't know, though. Not really confidence to me. All right, so a couple more things to look at here. We'll look at some notes in a moment. Looking at Goldman Sachs. Why? They're playing their book here. So I think part of the reason why we had such a violent squeeze is because hedge fund selling was never more furious than in the last 2 days. So if we look back here to SPY, we'll look at the one-day chart here. So again, the last couple of days here, where are they shorting? When was this published? This was published on the 14th, which was yesterday. So yesterday, they said the previous 2 days. So they were shorting very aggressively between the open on Monday and the close on Tuesday. That's a big old range. Where are we? Well, we're much closer to the bottom of the range than we are to the top. So I think that a lot of people started unwinding their positioning. And then we have to remember that there's a lot of options that also expire. So I think that some hedging came off and they started closing out the positions. So we now have to ask ourselves, again, when we look at the charts in a moment, do we have more evidence that the bulls are actually in control? Is this a short covering rally, or is there more to the story here? So Goldman data shows clients boosting short sales aggressively, leverage near 5-year lows as the S&P enters a bear market. So what this tells me is that, again, they see the order flow. They see their clients calling in and saying, "Hey, right, they're the prime broker." So everyone calls them. Right, offloading U.S. equities for a 7th straight day Monday with a dollar amount, blah, 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 blah. So this is really interesting because they have the playbook. And if we remember, Goldman Sachs was calling for 31.50. So they were calling for, give me 1 second here. So again, this is from Zero Hedge. So again, take it with a grain of salt, but the headline's correct here. Goldman Sachs sees S&P tumbling to 31.50 when the recession hits. When was this published? On the 12th. And then again, when did people start shorting it? The next 2 days, literally when they said we might drop by 1,000 points. So on the 14th or 2 days later, they tell us that it's never been more furious than in the last 2 days. Why? Probably because of their note published on Sunday. And then into the overnight session on ES or the futures market, we got a gap down. There's still a gap on the chart. So they shorted it into here. They shorted even more. And now, again, we have to ask ourselves, is this going to fulfill and go back up so that they actually close out those positions, potentially as high as about 395, which is where they started to initiate? Or are they going to hold on to those positions? And are we going to fade back down to, I don't know, like about 370 again? It's really, 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 really interesting. Have to also remember that 384, or almost the high of the day, off by 10 cents, is us getting back out of bear market territory. 384.00 is basically going to be our bear market territory. So we're going to get some very interesting clues as to whether or not we can actually form a higher high tomorrow. Because what is this here? Well, this is the potential for a reversal pattern. So if we fail to make a higher high tomorrow after staging one today, we're probably going to get an inside bar. And then the next bar break is going to be the most telling one. So if we can't form a higher high tomorrow, it means that we're going to be rejecting at bear market territory of 384, all right? 384. So that's really, 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 really interesting. All right, so a few more things to look at here. Again, trying to understand the motivation, because there's also that $3.2 trillion that starts expiring today all the way through to Friday. So we know that the max pain was around 390. So they got us up nearly 10 points off the low. S&P closed up today by 5 points, right? This is one of the biggest green days we've had since the last time Jerome spoke. So now what we want to look at is going to be, let's close this out. ECB also had an emergency meeting, right? Seems like something is already breaking. So generally speaking, the Fed will start to stop raising interest rates and start to ease when something breaks. And it appears something is already breaking. When? We haven't even made it to 2%. We're only at about, I think it's 175 right now. So that's very, 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 very important. The parts of the system are already breaking. He was asked a lot of questions today, and the notable one for me was in regards to quantitative tightening, where he said, I don't really think that quantitative tightening is going to impact the market's liquidity or stability. That was really notable to me. Anyways, a few more things to look at because I forgot about them is just the revised stuff we got from the Fed here. So changes in real GDP, the actual here, again, the line here is going to be the actual. This is their projection with the red line being the median, right? Median of the projection. So they think that we're going to come back down here in 2022, 2023, 2024 in the long run and have what? Well, not a recession. They're not forecasting one, but I think the Fed is inducing a recession. That's what I heard between the lines. The Fed chair is never going to say it, but people who are no longer at the Fed, including Bill Dudley, pretty much said that the terminal rate still has to go higher. So now we look at, again, we also look at the Pce Inflation, again, the Fed's favorite gauge. Here they show us that it's been rocketing higher, and now we have these ranges here. Again, range of the projection. It goes from roughly 4.5 to about 6.5, and then only down. So next year, right, 2022, 23, 24, 25. Let me just make sure I got those years right. Yeah, 22, 23, 24, and then the longer run. So that's really interesting because what the market is basically also implying, as we looked at before, is that Jerome Powell is right. We're not going to see higher inflation than what we see right now, and it's not at 3, it's not at 4, it's not at 5, it's at 8. It's at 8%, 8 to 10.5. So I don't know if this is really going to play out. But again, the saying is, do not fight the Fed. So what's going to be very interesting is whether or not we actually have a bull break or a bear break, because what that'll tell me is whether or not the market has conviction or confidence in these projections that we got from Powell. All right, so now that we understand the context, let's wrap this up to make sure we understand what's happening. Last time we had a meeting was May 3, May 4. So what we want to try to do is zoom back in time to see if there is a template for us to know whether or not we can get a predictor for where we're going to go. Right, March 4. So let me just double check here. So March 3 and 4. So last time we had a Fed meeting was right here on March 4, right? End up getting a doji, very similar to what we have today. And then what? Oh my God, a nasty, nasty drop, right? Yeesh. That's a 3.5% drop the next day. Whew. Right, so a 3.5% drop tomorrow takes us where? Down into the 360s, where these bears start to flex even more. 367.5. That would be a nasty break. And again, part of the reason why this happened was because it's also a Wednesday. Wednesday is OPEX. And then let people believe that this is going to be bullish. And then what? Pull the rug out. So we have some similar signals here in terms of the volume, where the green bar is bigger than the red one marginally. However, the big bar over here is green, which means people bought the dip and they were actually still green. When we look over here, not the case, right? We got a big fat red bar, and there's a whole bunch of people here who are trapped. So again, it's a little bit conflicting here. So May 3, May 4, right back to here is the, May 3, May 4. So the last time we had a Fed meeting was right here. And what happened next? Well, again, down and then up. So I don't know. It's very, very, very confusing. And because there's been record shorting at the lows, right? The record shorting at the lows. They're shorting the gap down. They're shorting the next gap down. It seems silly. But now we have to ask ourselves again, are we going to stay in bear market territory and reject or not form a higher high? Meaning we're not going to get above this area. Or are we actually going to make it there? It's really, 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 really important, because we have to keep in mind the higher time frames too. I don't have my other charts open, but that's okay. So now what I want to try to do is just explain what I was looking for going into today, so people can try to get a sense on what the playbook was. And full disclosure, I did make money today, but I got top ticked on the high of the day for ES, which means that I should have made about 4 or 5 times more. And again, if you hear me say that, I said should have, meaning I believe like the money was mine. It should have been in my account. And days like today are incredibly difficult to trade. So if you got hurt, or if you're saying shoulda, woulda, coulda, you're not alone. Even someone like me, who was very experienced, even on a green day, feels, again, keyword there being feels like I did not quite do what I should have. Power was out for me this morning. I wasn't able to trade the open. It set up exactly what I wanted. Also left a couple more $1,000 on the table. So even though I'm green, I'm feeling a little bit of remorse. All right. So here was the plan going into the FOMC. So again, what we're looking at here are the exact same levels we looked at yesterday. And I don't want to go into the tick by tick move, but we can note what were the key pivots, what were the lows, what were the highs. So I noted that we have these same important areas for today as we did yesterday. So important levels were 378.46, which is the 2020 high, 373.88, which is the 2020 close. And again, bears have scored 3 out of the last 3 weeks. So if these bulls are now going to start moving higher, and we note that they got 4 points when the bears got 2, it's now or never. We need to exit bear market territory and start at least giving ourselves a cushion. Otherwise, we're likely going to fade into the sunset. So we got 379.85, which was the open from the 13th. Where did we close? 379.2. Interesting. 350.54 was our previous 2022 low and overnight rejection on ES. And then 382 was a new high of the week, and we got there today. So I noted here, we are not bullish on the weekly until we get at least over 382. Poking above it is nice. Closing over it is necessary. So now as a follow-up to today, same levels as yesterday, but with the addition of 379.5 to 380. Yesterday's open. So where did we get to? Well, we poked above, but we did not close above 379.5. So that's really, really, really notable. We can also note that if we're going short, we have to be under the VWAP. We have to be, again, over 380 is a warning. Over 382, GTFO. And that's what really happened. We got a massive squeeze, and I think there were stops that were hit, myself included. So I literally got ticked at the high of the day. Again, I was already green on the day. I'll just explain myself really faster so people can get a little bit of context. I think this will help people who are struggling. I had a stop in for, again, I was willing to give back about a quarter of the profit I made on the day. I accepted the stop. It hit. And then when it hit, I'm like, oh my God, they literally hunted me. And then I did not do anything. Normally, I would try to trade my way through it. I would have gotten rewarded today too. So I think that if you're going to take a trade on FOMC day, you have to understand the risk and you have to be okay stopping out. There you go. If we lose 373 and 370, so if we're going to be bearish, we have to lose 373 and then 370 for a leg down. If we're going to go long, we have to be over the VWAP. We have to be over 380, which is going to be safer. And then over 382, there is a squeeze potential for a leg up. So now let's look over here to the 1 hour chart and just try to understand whether we were above or below the VWAP going into the meeting and then after. And this is important for me because it basically means that, where's my VWAP here? Turn it on. This basically means whether or not people were profitable going into the event. I'm actually going to go to a 30-minute chart because the 1 hour chart closes on the 30-minute. And actually, let's just go to ES. So I'll look at this one here. And on a 1 hour chart, what we can note is that we closed below. Then the hour going into the FOMC, what do we do? Close above, close above, close above, close above. So we closed above on every single hour leading into the meeting and then also after with what? Higher high, higher high, higher high. And now what? An inside bar. So same thing as we noted on the daily chart, where this inside bar breaks, either bull or bear, into the next hour, which will close here in about half an hour and open up in an hour after that, or it's going to open at, I think it's roughly 6 Eastern. That's going to tell me the short-term direction. Post-Powell, post-expiry for today, which was OPEX. Are we going to go up? Are we going to go down? And when we look here, is this a bottoming pattern? Right. Inverse head and shoulders. It's not like fantastic, but it held. And the low we established yesterday also held, like we noted on crypto. So we're seeing some positive signs here. However, did we clear the level needed to have confirmation or have more conviction? Answer is no. So we failed to get above 379.5 and 380. We also failed to get above 382. However, here's something else I'll note. When we look across to the rest of the world, notably the DAX. So the DAX did not have a chance to trade through this FOMC meeting. So what did they do? Well, it closed up by 1.3%. They said, we feel confident holding through with Jerome. I think he's going to do us good. And now the FDAX is up here by about 1.9. So that tells me that we're up by another 0.6, and people think that's bullish. So it's pretty notable to me. Even as the dollar got weaker, which would normally add weakness to other markets. So now if we go back to SPY and we try to understand that that's what happened, what's our high of the day? 383.9. What does that mean? We can gap as high as 383.9 and not have a gap on the chart, which means that if overnight the rest of the world is bullish on what Jerome Powell had to say, we should be able to gap up. Where? Well, ideally above 380.5 and then blast through that high of the day, get inside the gap zone, make progress towards 384, claim it, and then go higher. On the flip side, if we're going to get that puke, it's probably also going to happen tomorrow, right? So we know here that was the big move. Why? Well, we're getting awfully close to expiry, and there's going to be options that expire pre-market, in the morning on Friday, which means the closing price on Thursday is going to determine whether or not they get their money. And again, that's for the large SPX straddles. So scenario one is that we get a bull break or we get back above 384 and exit the bear market territory. Option two is that we lose today's low of the day at 372.12 and then we reject there and fall below 370. So my notes also said that below 373 was a warning. So if we tie this all together, the bears got us below 373 and the bulls got us above 382. So whoa, right? This is a little bit confusing. Yep. But we are closer to resistance than support because we're at 379. So whichever way this decides to break, we have to believe it. It breaks bullish. It's probably going to want to go for at least a gap fill, maybe back test, hit the second one, back test, and maybe go higher. If we break down tomorrow, I don't think we're going to look back because there was that record aggressive shorting for the last couple of days here. Other thing we can note is that, again, so chart's going to do three things. They can go they can go up, they can go down, they can go sideways. Getting an inside bar for tomorrow would also be very interesting. Why? Because of the range we're controlling. We are below 390, which is maximum pain for the straddles. The people who are short are not exiting. They are holding on. That is also notable. So if we get an inside bar tomorrow, then Friday is where we're likely going to get that break. And same thing as we noted here. When we were in I'll show one more thing just to make sure it's a little bit more clear here that once we lose the range, it can get very violent. So when we look here at the weekly chart, we can now note that, again, we had our low, our higher low, our high, our higher high, and then an even higher high. But then into the next week right here, what do we have? We had an inside bar. And once we lost the low here at 40693, what happened? That was last Thursday, if you don't remember. Woo! 10%. That's how far we fat. That's how fast and far we fell. So the exact same thing that broke bearish here on the weekly is what I'm paying very close attention to on the daily. And if I'm confusing you, drop me a comment and let me know. Otherwise, I think that is going to be where we're going to leave it today. DXY, VIX, 2 years, 10 years, all down, which is positive. Most risk assets are now going to be green. And we're going to have our what day is it today? Wednesday. Oh, tomorrow's, I thought it was already Thursday. Anyways, if you want to watch more content and you want to see how we got prepared leading into this week, there'll be a video that'll queue up here in a moment for the weekend deep dive. Otherwise, I thank you very much for watching and drop me a comment. What did you hear from today's meeting? What did you see on the chart? And whether you are bullish or bearish. Thank you so much. I'll see you tomorrow.